In Q1 2025, overall household liabilities grew by 5.2%, marking the sixth consecutive quarter of growth in this area. The total liabilities reached approximately $384.1 billion, which represents the cumulative borrowing by households. What stands out is the composition of these liabilities. About 72.9% came from mortgage loans amounting to roughly $280 billion, while the remaining 27.1%, around $104 billion, was made up of personal loans. This distribution indicates that most households are relying heavily on property financing, a pattern that is seen as typical in Singapore, where around 70% of household debt is mortgage-related. Despite the upward trend in liabilities, household assets have grown even more robustly. In the same period, asset growth reached 7.8%, a pace that outstrips the increase in liabilities. The asset base is divided into two major categories: residential property assets, which account for about 44%, roughly $1,535.3 billion, and financial assets, making up the remaining 56%, approximately $1,955.5 billion. This strong asset growth has resulted in an increase in household net worth by 8.1% year-on-year in Q1 2025, elevating the total net worth to around $3.49 trillion. This trend reassures that even though households are taking on more debt, they are also building considerable financial security. Over the past 20 years, there has never been a quarter where household liabilities have grown faster than assets. This consistency suggests a resilient and improving economic environment for Singapore households. Additionally, the steady and uninterrupted rise in personal disposable income by 5.2% year-on-year to $93.3 billion in Q1 2025 reinforces the notion that households are benefiting from a robust income growth. Another critical factor highlighted is the impact of falling interest rates. Lower interest rates have eased the burden on households by reducing the cost of debt servicing, thus allowing families to manage their rising liabilities more comfortably. This policy environment, paired with the strong performance of both residential and financial assets, creates a cushioning effect against any potential economic shocks that could arise from higher debt levels. The emphasis on property-based financing and the consistent improvement in disposable income signal that the Singaporean economy is structured to support long-term household wealth, even as it navigates the challenges of higher leverage.